So I've said that for the question 2, it will be business valuation or mergers and acquisition. So always it is business valuation. It was only once that they brought a question on mergers and acquisition. But right now, what they are doing right now is that they normally mix it. They will bring, or they can bring a combination of a question that will be on business valuation and also mergers and acquisition. That's what they are doing right now. So you can see a question on business valuation, you can see a question on mergers and acquisition, or you can see a mixture of a question that will be for business valuation and mergers and acquisition. What do we mean by mergers and acquisition? You see, those who are learning or those who have learned uh, group accounts, you see that a company wants to expand. So what they have to do is that they have to go and acquire a company that is already operating in the country or in the region or in the city that they want to expand to. So that is the acquisition. A situation where a company wants to expand, they want to establish their presence in a different location, and they have now decided to go and purchase what? A company that is already what operating in that particular region of that particular country. So mostly I use MTN. So MTN want to expand their operations to Togo. They want to have their existence in Togo. What they can do is that they can go there and do everything over there themselves. So they will go there, rent a space, then they will bring machines and everything themselves. They will bring their own employees. They will do everything. So they are going to take care of all the activities that is relating to them having their branch or their subsidiary in Togo. They are going to do everything themselves. Another way, MTN can say that, okay, doing everything ourselves is going to be expensive to us. It's going to cost us. So what we'll do is that we are going to acquire a telecommunication company that is already operating in Togo. So what they will do is that they can acquire any of the Togolese telecommunication company. Either can be Togocell or the Move. So MTN will acquire that. If they do that, that is what we call the acquisition. But if they are doing the thing themselves, we say that is what we call internal expansion or internal development or organic expansion. All right. MTN can also decide to go and take over a company or a telecommunication company that is not doing well in Togo. That is also a way of having their presence there. So what they are going to do is that they will now introduce their MTN products through that particular company that they are taking over. MTN can also decide to go and merge with a company that is already operating in Togo. So if the MTN want to have their presence in Togo, they can go and acquire a company that is already operating there. They can go and do everything themselves. They will establish their presence themselves. They will send their machines, they will send their employees and everything. Or they can also go and combine their business operations with a company that is already operating there. That is what we call the merger. So the mergers and acquisition is talking about a company want to expand its operations, but what are the options that they have to expand? They can do it themselves, which we call the organic expansion or the internal expansion, or they can also decide to acquire a company, or they can expand by acquiring a company that is already operating or merging with a company that is already operating. So that is the mergers and acquisition. We are talking about expansion. A company wants to expand its operations to a different jurisdiction. What are the options that they have? They can do everything themselves. They can have their presence over there by acquiring a company that is already operating there. So that is all about the mergers and acquisition. That's all about the mergers and acquisition. Okay, if I have a company right now, Assurance Professional School on the ICA website, our location is East Legon. Okay, but if I want to have presence in Kumasi, I want to have a physical presence in Kumasi, I can go there and rent a place myself and start everything myself. Or I can have a presence in Kumasi by now merging with a center that is already there. Or I can go there and say, okay, the person is saying that, okay, I will not be in a country, so I want to give my center to someone for a fee. So I can acquire that particular person's center and change the name to what? Assurance Professionals. Okay, that's what we are calling the mergers and acquisition. So the mergers and acquisition is only talking about what? Expansion. The company wants to expand. What are the options? What are the options? So I've said that the company can do the expansion themselves, or they can what? They can do that through mergers or acquisition. So we are going to look at them one by one. So we have the organic growth. We have the organic growth. That is the internal development, which the company is going to use their assets, their expertise to what? To carry out the expansion themselves. So that is the organic what? Growth. That is the organic growth. One thing about organic growth is that the entity can control the growth because they are using their own what? Machines, their own expertise. So they know the size of the expansion that they can undertake. They know the level of the employees that they have. They also don't know the level of machines that they have. So they can control the what? The expansion. They can control the expansion. We know our capacity, so we can't go there and be putting up what? 2-story buildings. No, we know our capacity and we know that we don't have the resources to do that. So we know how to what? How to manage the what? The expansion. The company can also use their existing expertise to what? To carry out the expansion. Maybe they have employees now who are skillful, so it's not necessary for us to go and buy a company that is already operating. We don't know the nature of the employees that they have, but since we have IT people who can help us with the expansion, who can help us to establish the system for us, it will be advisable for us to use our own what? Employees than going to acquire a system that we have no idea about. All right. Another one is that sometimes it is less what? Expensive. Sometimes it's less expensive to the extent that sometimes the company that you are going to acquire, you are going to be paying what? Acquisition premiums. Sometimes you pay more than you should. You pay more than you should. But if you are doing the expansion yourself, that will be what? That will be better. Okay, sometimes if you are going outside to buy food, it's sometimes expensive that we are preparing the food yourself. And sometimes too, if you are preparing the food yourself, it's more expensive than what? Going out to what? To buy. So that is the option over here. That is the case that we have over here. The internal expansion can be expensive as compared to the acquisition, or the acquisition can be less expensive comparing to what? This particular one. It depends on the nature of what? The expansion that the company is undertaking. So these are some of the what? Some of the advantages associated with what? With the internal expansion. The company can use its existing what? Resources to what? To carry out the expansion. All right. Another one is that the company will be operating. Okay, another advantage is that the company will be operating its what? Its organizational culture, its management structure. There will not be any change in the management structure. But if the company is acquiring a different company, that particular company might be using a matrix structure, and these people must be using a functional what? Structure. But how do you combine marginal matrix structure with what? With functional structure? That is going to be having a lot of issues. So sometimes the integration, how to put the two business together in terms of the organizational structure, will be a problem. But if you are carrying out the expansion yourself, you will still be what? Implementing your what? Your existing organizational structure. All right. Some of the disadvantages is that the organic expansion, sometimes it can be more expensive than acquisition. And sometimes it can also take time because you are going to put the operation, you are going to what? You are going to send the machines there yourself. You are going to put certain things up over there yourself. It will take time as compared to you going to what? Acquire a company that is already operating there. The company, they have the machines, everything over there. So you start operating what? Immediately. But so the internal expansion sometimes takes time before you put up the place, or before you make the place ready. It is going to take some time. But if you are acquiring a company that is already operating there, the company is already operating there, they have everything over there, so you can start operating immediately. All right. Another one is that internal expansion, you are going to look for customers yourself. So it will not give you access to what existing markets. There will not be any access to what existing markets. But if you are acquiring a company, TogoCell already have what customers in Togo. So if you acquire them, it means that indirectly you're also acquiring their market share. The customers that they have, you are also acquiring them. You are also acquiring them. You are also acquiring them. So these are some of the what? Some of the disadvantages. Let's come to the inorganic growth, or what we call the acquisition, the mergers and acquisition. Okay. The acquisition is you buying a company that is already operating. You want to expand by what? Acquiring a company that is already operating in the jurisdiction that you want to expand to. So if we want to go to Nigeria, right now we want to have existence in Nigeria, we want to be providing what? Professional teaching to people in Nigeria. What we are going to do is that we can go there and look for a place ourselves and bring our equipment that we are going to use, or we can acquire a teaching center that is already in Nigeria and change the name to this one. All right. So buying the teaching center to change the name to our name, that's what we call the acquisition. Or we can also go there and merge with a teaching center that is already operating there. So we now become a two teaching center now becoming one. That is the merger. All right. What will happen to the acquisition? What are some of the advantages of the acquisition? The acquisition is the first one is the speed. It is very fast. After negotiating, you just pay for the business that you are buying, the portion of the equity shares that you are buying, you pay for it. Then the business, now you are the majority holder, you can start operating. Or the business will even be operating before you acquire them. So they will still be operating. So it's very fast as compared to what? To the internal what? Expansion. The internal expansion, assuming you are going to put out the structure yourself, you have to get the people, they will start the construction of the building and so many things. But acquisition, the building and everything is still there. It's already there. So you just start your operations immediately. All right. Another one sometimes too is what? It is less expensive. It is less expensive. If the company is good at negotiating, the cost of acquiring a company as compared to what the internal expansion is somehow okay. So sometimes less expensive. The company is good at what? Negotiating. So they can acquire the company at a lower cost. So sometimes it is less expensive. The issue about expensive can also be advantage and disadvantage. Sometimes the company can be paying more than it should pay, and that will be a disadvantage. All right. Another one is what? Acquisition of intangibles. Acquisition of intangibles. Okay. The company that you are acquiring, they already have what? A good relationship with what? With the customers. Where they are located is what? Is a strategic what? Location. They have skilled employees, and these are all a goodwill to the company. These are all the factors that contribute to the success of the company, which we call the goodwill. So if you are acquiring the company, it means that indirectly you are acquiring the what? The strategic location. You are acquiring their good relationship that they have with the customers and the suppliers, and you're also acquiring the skilled employees that they have. And all these things put together is what they are calling the what? The intangibles. The intangibles. All right. Another one is what? Access to overseas markets. So if you are acquiring TogoCell in Ghana, it means TogoCell in Togo. If MTN is acquiring TogoCell in Togo, it means that MTN is what? Is also having access to the markets that TogoCell operates in. That is the Togolese what? Telecommunication what? Industry. They are having access to that particular industry. And they can now go to Togo and sell their MTN products. That is the access to the overseas market. It's not actually should be maybe you are buying the company in US or anything. The overseas can be maybe Togo, even Kumasi. It's not that whenever you are going to travel outside, it's not that always you have to use the sea. You can use the plane, so it's not overseas. But there's something that is outside the jurisdiction that you operate in. That is the overseas that they are talking about. So Kumasi can also be the overseas because Accra and Kumasi are two different jurisdictions in terms of regions. All right. Another one is also that it creates what we call competitive advantage. Look at Airtel Tigo right now. Airtel Tigo right now can be in a better position to compete with what MTN and Vodafone. They say that two good hairs are better than one, not just two good hairs, not just two hairs. No, it should be two good hairs. Okay, if no, two hairs are better than one. No, that is not a correct statement. It should be two good hairs. What if you put two lazy people together? What can they contribute? No. But if you put two hardworking people together, you know what they can contribute. So two good hairs are better than one. All right. So if you look at Airtel Tigo right now, they can be in a better position to compete MTN and Vodafone than they should be alone. Airtel Tigo cannot do it. They cannot compete as they are competing now after they have merged the Airtel Tigo. All right. So if you acquire the company, it will also give you a form of a competitive advantage. Okay, you are good at what? You are good at operating, or you are good at developing what? Online apps. Okay, the company that you have acquired, they are also good at what? Developing websites. It means that you are now adding development of website to development of apps. This will now give you a form of advantage over your competitors, because you can develop your own website and can develop your own app. So acquiring a company will give you some form of competitive advantage. It will give you that particular energy to be in the best position to compete in the market, to compete in the market. That's why they are saying the competitive advantage. It will give you some form of benefit over your competitors. That's why we are selling, or we are calling the competitive advantage. It can also create what we call a synergy. Synergy is a form of force. It's a form of force that the two of you are going to be bringing together, or it's a form of benefits. Synergy can be something that if you are doing it together, the cost that you are going to be incurring will be reducing. So synergy can be revenue synergy, financial synergy, or anything. Synergy is a form of benefits. Okay. If you are having a CFO, the company that you are acquiring is also having a CFO, you can decide to now use one CFO for the two companies. It means that the cost of the other CFO will be saved, and that is what we call the cost synergy. So you are going to reduce costs as a result of the acquisition. So this can also give you a form of benefits. So if you are producing cars, that company is also using a machine. This company is also using the same machine. You can decide to produce the cars using one machine now. You're also saving some kind of the operating cost. That's what we call the synergy. All right. What are some of the disadvantages? All right. Some of the disadvantages is is exposure to business risks. Okay. The exposure to business risks has to do with you are in Ghana and you are acquiring a company in Togo. You see, the legislation that is regulating the companies or telecommunication companies in Ghana is different from the legislation that is also regulating companies in Togo. Okay, Togo, they might be saying that before you can operate, you need to acquire a license of this amount, and at the end of every year, you have to renew your license. But in the case of Ghana, you only have to acquire the license, but you are not going to renew it. You can see that you are having two different rules or legislations. So if you go to Togo and you don't want to renew, you will not be able to operate. So they are giving you exposure to a business risk, which is the annual renewal of the license that you are using to operate. So the two regions are going to, or the two countries are going to be having different legislation as to the operations of the telecommunication industries. So if you are buying a company in Togo, it means that you have to comply with their legislations, and that is also giving you a form of operating or a financial risk, because if you don't do it, it is going to affect your operations. So as soon as you are going to a different industry, the operations over there will be different from how you are operating, or the operations in the industry that you're operating. That is a form of what? Business risks. That is a form of business risks. Business risks can also come in a form where you want to do what we call unrelated what? Acquisition. That is, you are acquiring a company that is in a different line of business apart from you. You are into telecommunication, those companies are to hospitality. If you want to acquire them, you are going to be what? Your telecommunication operations is different from hospitality operations. So the hospitality operations will now expose you to what we call the business risks because the nature of the operations are different. That's what we call the business what? The business risks. Business risks has to do with the operations of the company. All right. Let's come to what we call exposure to financial risks. Exposure to financial risks. Okay, the financial risks that we are talking about over here, we are talking about the risks associated with the financial structure or the capital structure of the company. Okay, currently, your company is being financed through only equity. You don't have any debt. But the company that you are going to acquire, they are financed through what? Debt and equity. You are not familiar with what? With the issues with debt. So if you are going to acquire that particular company, it means that you will be paying interest on the debt. But right now, you are not paying what? Interest. Or currently, you are being financed through, or MTN is being financed through equity and debts in the proportion of what? 60 to 40. But the company that you are going to acquire, their capital structure is 50 to 50. You can see that they are having a different what? Capital structure. What it means is that you will be paying more interest in the company than you will be paying right now. Or if that particular company is having 40 to 60 capital structure, equity is 40, debt is 60. They are now exposing you to what? To the risks of having a higher cost of equity and also having a higher what? Weighted average cost of capital. So the financial risk has to do with what? The financial structure, the capital structure of the company that you are operating. If it is different from how you have been operated, if it's different from your capital structure, that is also going to be what? Be exposing you to some risks. The risks will be in the form of additional interest that you'll be paying. Or the risk will be the inability to what? To maintain a lot of profit because you'll be paying higher of interest. All right, that is a financial risk. Let's also come to what we call acquisition premium. Acquisition premium. Is it sometimes what will happen is that the company will be asked to pay more than the current market value. So the market value of the company can be 40 cedis, but you are going to pay what? 50 what? Cedis. The 10 cedis that you are paying is what we call the acquisition premium. So they can say that although the market value of the company is this amount, you have to pay this amount, and that particular amount is representing what we call the premium, which you people call goodwill in financial reporting. But if you come to financial management, there is nothing like goodwill. So that particular excess amount that we are paying, it is called the cost to the entity, which is what? Acquisition premium. Acquisition premium. So sometimes the company will pay above the present market value of the entity. Why are they doing that? Maybe they are paying for the location. But in financial management, we don't consider those things. We don't consider them. So you are paying what we call acquisition premium. You are paying for what we call acquisition premium. Okay. Let's look at what we call the integration problems. The integration problems. The integration problem has to do with the organizational structure. So the company, MTN, is operating functional structure. MTN is operating functional structure. But the company that they are going to acquire, they are operating a divisional structure. How do we merge or how do we integrate the two organizational structures? It will be very difficult, and their culture will also be different. The issue is for the Togocel, by 6:30, everybody have to be at work. By 6:30 a.m., everybody have to be at work. Or at MTN, by 6:30 a.m., everybody have to be at work. But for Togocel, by 8:30 a.m., that is when people have to come to work. So you can see that 6:30 and 8:30. How do we change these people? there's going to be a problem before there will be, because you are going to implement a change and people have to resist the change if they know that the change is going to affect them. So you'll be having issues with what the different culture of the two organizations. That's what we call the integration problems. So how do you incorporate the culture, the organizational structure of the company that you are acquiring to your existing what culture? If they are different, how do you manage it? You have to force people to do what you want them to do. No, that would be somehow impossible. That would be somehow impossible. All right. Another one is also dilution in proportion of ownership. Dilution in proportion of what? Ownership. What do we mean by dilution in proportion of ownership? You see, if you are shareholder in the company that we are buying, so company A is having 10,000 shares, company B is having 5,000 shares. Okay, if you are shareholder in B and you have 2,500 shares, it means that your shareholding is 50%. It means that your shareholding is 50%. Now, if A acquired B, it means that we are going to put the two shares together now to have a share of one company. So we are going to be having the A group. So the total number of shares will now be 15,000. Okay, so you that you are having 22,500 shares, you no longer be having what? 50% shares, because your shareholding will now be based on the total number of shares. That will be 2,500 divided by 15,000 times 100. And what are you going to be getting? 2,500 divided by 15,000 times 100. And you now be having 16.7%. That is why we can say that the ownership has changed as a result of the acquisition. So the change in the ownership is what we are calling the dilution in the proportion of ownership. So if the two companies, there's an acquisition, the shareholding of the shareholders are going to be changing, because the shares of the two companies will now be put together. So the proportion of your shareholding will now be changing. And that's what we call the dilution of what? The dilution of proportions in the ownership. So we are talking about the shareholding. All right. There's also another one there called the managerial competence. Okay. So the managerial competence is that sometimes you don't have much idea about the operations of the company. So you just went ahead to acquire the company. You have now realized that no, the existing management that we have cannot handle the operations of the company. They don't have the competence, they don't have the expertise to manage the operations of the company. So that is also going to be a problem to the company. The existing management not having the ability or not having what it takes to acquire or to manage the operations of the new company, or to even manage the operations of the two companies at a go. So they don't have the ability, or they don't have what it takes to manage the operations of the two companies right now. All right. So basically, these are mostly last sitting they have asked about the advantages of the acquisition, and we don't know what is going to happen. Let's come to merger. Let's come to what we call merger. Merger is what two companies coming together. Nobody is buying anybody. There is no payment for the shares. We are just joining forces together. That is a merger. Amalgamation is also a form of merger. But what happens to merger is that when the two companies merge, they will now come with what? A different name. So you can see that Airtel Tigo, they have now come with the name Airtel Tigo. Tigo and Airtel, after they merge, they now come with the name Airtel Tigo. This is a different name because their names were Airtel Ghana or Tigo Ghana or something. Or they have Airtel was first Zinc, they now change it to Airtel. So their name were different. Airtel, different. Tigo, different. But after merging, they now come with a different name, which is what? Airtel Tigo. With amalgamation, the two companies will merge, but the company with the highest shares or highest resources will put their name on the company. So they will maintain one of the names. They will maintain one of the names. Okay. What are the types of merger that we have. We have what we call the horizontal merger, and we also have the vertical merger. Under the vertical merger, we have what we call the backward and also the forward merger. We also have what we call the conglomerate merger, which is unrelated merger. If you are talking about horizontal merger, okay, you are saying that you are doing horizontal merging. So horizontal means like this. Horizontal means what? Like this. So if we're in the office, the two of us are sitting like this, the meaning is that the two of us are of the same position. They are of the same rank. It's just like a horizontal communication. Communication existing between people of the same level. People at the same level. So if we are talking about horizontal merging, we are talking about a company merging with its competitor. They are merging with its competitor, a company that they are operating at the same level. So the Airtel Tigo is what we call the horizontal merger. Horizontal merger, because you are merging with with your competitor, someone in the same line of business. That is your competitor. So horizontal means what? Merging with your competitor, your direct competitor. That is a horizontal merger. And that is Airtel Tigo. That is the Airtel Tigo. What about the vertical? Okay, the vertical is like this. So the vertical line, what will happen is that you are not going to be on the same line of business, but you'll be in the same line of distribution. You'll be in the same supply line. So it can be you are a customer and you are now coming to buy your supplier, or you can be a supplier, then you are buying your customer. That's what we are calling the vertical integration. So the vertical integration is not merging with a company in the same line of business, but a company in the same supply chain. So you can be a supplier here. If you're a supplier, it means that you sell to your customers. So if you're a supplier, you are going to be producing and sell to and sell to your customers. So your customers are going to be ahead of you in the supply chain, because the goods will move from you to your customers. So they are going to be ahead of you in the supply chain. So if your supplier is acquiring each customer, then that is what we call the forward integration, or the forward merging, or forward vertical integration, or forward vertical merging. So a supplier is acquiring the customer. What does that mean? You see, a company that produces tires, is buying a company that produces car. So it means that you will be selling the tires to the car manufacturing company. So the car manufacturing company is your customer. So if you are the company that you are producing the tires, you are acquiring a car manufacturing company. That is what we call the forward, because you are acquiring someone in the front of you within the supply chain, or someone who is ahead of you in the supply chain. Another one is a leather. A company that produces leather is acquiring a shoe manufacturing company. You see, the leather will be given to the shoe manufacturing company, and they will use the leather to manufacture the shoe. So the company manufacturing the leather is the supplier, and you are now acquiring your customer, and that is what we call the forward. What about the vertical? What about the backward? The backward is where you, the customer, you are acquiring someone that you are ahead of. So you are ahead of the customer will be ahead of the supplier, because the supplier will give the goods that they have produced to them. So if a customer is acquiring a supplier, that is what we call the backward. So you can see the the customer is ahead over here, and they are acquiring the supplier over here. So it can be a car manufacturing company acquiring tires, a company that is producing tires. Okay. It can be a shoemaking company that is acquiring a leather manufacturing company. All right. Why do we do this particular integration? Why do we do this particular integration? You can see that if you are doing vertical or the horizontal, the backward or the forward, you are going to be having access to you are going to be controlling the distribution channel. What is going to happen is that if you are a supplier, you are buying a customer, it means that the customer you'll be supplying to them directly. You'll be supplying to the customer directly. So you are going to be having access, you are going to be having control over the distribution channel. So you are going to produce and you give it to them directly to sell. You don't have to go and look for people that will come and buy. But if you're also a customer that you are buying a supplier, it means that you're also going to be having access over the what? Over the raw material. Because the company that is going to give you the raw material, you are the owner. You are the owner. So those costs of transporting the material and those things, you are going to be what? Ignoring them, or you are going to be avoiding them. So the vertical integration gives the company a form of what? Advantage over its distribution channel. And it also gives the company a form of what? Competitive advantage, because you are producing your own thing. Whatever you need, whatever raw material that you need for your production, you are going to produce it yourself. So there will not be any shortage. You don't have to go to somewhere and the person will be saying that we don't have raw materials. So that will give the company some kind of what? Advantage. They are going to be having a control over the what? The distribution channel. And it also can help the companies to join forces together and fight their competitors. So to give us some kind of what? A force over the other companies. Okay. All right. Let's look at the conglomerates, which is the unrelated what merger. The unrelated merger over here, a company is what is merging with a company in a different line of what business. What does that mean? The meaning is that MTN is now merging with what? Kasabreku. MTN is now merging with Kasabreku, or MTN is now acquiring what? Kasabreku. And this is what is always what we call a diversification. The company is now diversing what? Its line of business. Its line of what? Its line of business. So you are now merging with a company in a different line of what? Business. So MTN merging with Kasabreku. They are in two different line of business, and that's what we call the conglomerates or the unrelated what? Merger. Unrelated merger. All right. All right. We talk about synergy, and we say that synergy is a form of benefit, or it's a form of advantage that a company is going to be enjoying as a result of the merger or as a result of what? The acquisition. All right. Okay. So what we are talking about is that the synergy I've spoken about where you have two CFOs and you have now decided to what? To now use only one CFO. It means that you will be reducing the labor cost. One of them will be laid off and you are going to pay the person. But the money that you are going to be paying the person, if the person should be working for the organization, will be more than the money that you are going to pay the person off. Okay. It can also be that a company is what? Is using two different machines to produce. Now you have acquired them. You can decide to rent what? Or to lease the what? So other machine and use your one machine to carry out the production. That is also a form of what? Synergy. Okay. If you are combining your operations or if you are acquiring a company, it means that you cannot produce in a large quantity, which is going to increase your revenue. So the benefits can come in a form of what? In a form of revenue, where you are now going to produce it in a large quantity or at a large scale, and that will going to increase your what? Your revenue. Or you have acquired a company that is having what? 100 branches across the world. So it means that the revenue that will be coming from those ones will be your revenue. So it will be increasing your revenue. It will be increasing your revenue. Okay. Another one is also the cost. The cost can be the one that I've said right now, which is a company having two CFOs and they have now decided to use only one. They are going to be saving costs. Or the company, whatever you are going to produce, fixed cost will still be the same. So the company can now produce at a large scale. That is going to give them economies of scale. Because if you are producing 1,000 units, and paying 5,000, so 1,000 units and you're paying 5,000. If you decide to produce 10,000 units now, you'll still be paying what? The 5,000, all things being equal. So you are going to be enjoying some form of economic skill that is going to what be giving you more revenue than your cost. All right. All right. So you can also enjoy what we call the financial synergy. Okay. You can also financial synergy has to do with something involving money. It can be tax benefits. Okay, you are buying a company in a jurisdiction where certain things are being allowable for tax purposes. So in that case, it means that whatever is going to happen over there, you are not going to be paying tax on those particular things. You see, Ghana, if you incur expense that is not wholly necessarily and exclusive to the operations of the company, the tax authority is going to disallow that particular operation. Example is what? Entertainment cost, or refreshment. How is refreshment related to what? To the generation of revenue of the company. No, you are doing your own entertainment. Are you using that particular cost to generate revenue? Are you generating any revenue from the entertainment? If yes, then it means that that particular cost must be matched against the revenue. But if you are having depreciation, you see that the depreciation, you are using the asset to what? To generate the revenue. That's why the tax authority will give you capital allowance. If you're having salaries, why are you paying the salaries? You are paying the salary because the people are working for you. So these people are doing production. They are carrying out the production work. So the salary is a cost incurred to generate the revenue. So since we are going to tax the revenue, it means that we have to give you tax benefits on the cost that you also incur to generate the revenue. But if you go to the company that you are acquiring right now, if you go to their jurisdiction or their country, maybe entertainment expense and all those things are allowable for tax purposes. It means that you'll be enjoying tax benefits on that. And that's also a form of what? Financial synergy. All right. Another one is also the diversification through conglomerate merger. Okay, through the conglomerate merger. So right now, MTN is now merging with Akasa Beku. Yes, this is something that is different from the operations of MTN. But in this case, if this is done very well, this can now lead to something like increase in value. If it is done very well, Kasabego can be operated to generate what? A higher amount of what? Revenue. That is what we are to to do. All right. So I'm going to talk about we are saying that a company can expand through either merger, acquisition, or organic what? Growth. All right. Right now, you see, sometimes you want to acquire the company, or if you want to merge with the company, it is not something that is easy. You see, some of the shareholders may decide not to sell, or management some people they will not be willing to sell the shares to you. Okay, so you have some situations where it will be advisable for you to use the organic growth, which is the internal development or the internal expansion. You will do everything yourself, because if you want to acquire the company, some of the shareholders or some of the people might not be willing to sell, and that is going to be that is going to present a major threat to you. So sometimes the company that you want to acquire, which we call the target company, okay, business valuation, I've told you that the company that they are going to acquire, the victim company, is what we call a target company. And the company that is going to acquire the other company is what we call a predator company. All right. So the target company, the owners of the target company may not be willing to sell, or they don't want to sell the company. So what they are going to do is that they are going to try some kind of defensive mechanisms to prevent you from buying the company. So they are going to play some kind of tactics with you that will discourage you from buying the company. The first one is that the company that you are going to acquire can make what we call a reverse offer. They can do a counter offer, where they are saying that they want to acquire you. You are saying that you want to acquire them. You are saying that you want to acquire them at a price of 5,000. They will say that they want to acquire you at a price of 10,000. You can imagine. The company that you are going to acquire, they are now telling that they want to acquire you for 10,000. So the company can make what we call a counter offer or a counter bid or a reverse what? Offer. A reverse offer. So they want to discourage you from buying. They want to tell you they have money than you, so they can acquire you instead. So that will be a strategy. Since you are going to buy something, or you say you want to take someone out, and the person is saying that I want to take you out instead. Yes, because of that embarrassment, you will not be willing to carry the person out again. Yes, that's what we are talking about over here. All right. Another one is that the shareholders or the management can also convince the shareholders that they should not sell. The company is having what? Prospects, so don't sell. The company is having prospects, so don't sell. So the management can convince the shareholders that the amount that the people are paying for the shares are not the actual price, so don't sell. So don't sell. So they can convince the people that the amount that those people are offering is not good. So don't accept it. Don't accept it. Okay. The company can also, see you want to buy them, they can decide not to sell to you. They will go and look for another buyer who will come and buy them. So they can offer themselves to what? A different company. Okay. So they can they can also try to find a more acceptable counter bidder for your company instead of the original predator company. This is refers to as what? White knight what? Defense. So what they are going to do is that they don't want to sell to you intentionally. So they will go and look for a company that is having what? That is offering a higher amount than the company that want to acquire them. So they can find a different company that they should come and what? They should come and buy them, or they can offer themselves to a different company at a price higher than the price that the predator company is offering to them. They can also demand what we call higher sovereign what arrangements. So the issue is, if you are going to buy the company, it is likely that the company will be bringing some of their, or they will be laying some of the workers off. So what will happen is that if you want to lay us off, you have to pay us a sovereign's payment. So what will happen is that they can demand a higher amount of it, which the company will not be willing to pay. And that is what we call the golden parachute. So in the exam, they can ask you to explain the following: reverse takeover. That is a situation where the company will make a counter offer to buy the predator company. The target company is now telling the predator company that they want to buy them at a price higher than what they are offering them. We also have what we call the white knight defense, where the company is going to offer themselves to a highest bidder or a different company rather than a predator company. We also call something which is what we call the golden parachute. The company or the management of the company are now demanding for a higher redundancy cost. That is a golden parachute. So they can name these ones and ask you to explain them. Okay. They can also make the management of the company can also make the company unattractive to the predator company. How would they do that? They can sell all the productive assets. It's because of the asset that you want to buy the company. You want to buy the company for their assets, or maybe they have an asset that you don't have. So you want to have access to that particular asset. That's why you want to buy them. What they will do is that they can sell that particular asset. So if they sell it, it means that you don't have interest again, because you are coming to buy the company because of that particular asset. So after they have sold the assets, you are not going to be, or you will not be willing, or the company will now look unattractive to you. Okay, it's just like a lady is putting on a wig, or I don't know how they call it, and you are attractive to her because of the wig. She can make herself unattractive by removing the wig. That is the situation that we are talking about over here, and that is what we call the poison pill. The poison pill. So the company is trying to give them poison. Why? They are selling or they are giving them what they don't want. So they can try to sell their productive assets, and that will discourage the other company not to buy. All right. These are the theoretical aspects of the mergers and acquisition. But we are going to look at something. You see, if two companies are merging, it is likely that there can be a benefit. There can be what? A benefit, or there can be a gain through the what? Through the merger, or there can also be a cost. If it is through acquisition, there can also be a cost to what? To the company that is acquiring. For example, the value of X is 50 million, but Y is offering them 60 million. Okay, what is happening here? The value of X is 50 million, but Y is buying them 60 million. What is happening? What is happening? Again to who? There is again to who? X or Y? How much are they paying in excess? Okay. How much, Auntie Akuya, how much is X paying in excess for Auntie Akuya, are you here? Auntie Akuya, are you here? All right, let me take a different. Philip, are you here?
Yes, please.
Okay. So X is having a value of 50, Y is paying 60. What is happening here?
Excess of 10 million.
So the 10 million, what will be the 10 million to X? The shareholders of X, what will be the 10 million to them? And the shareholders of Y, what will be the 10 million?
I don't know, is X acquiring Y or
No, Y is the one acquiring X.
X? So for Y, it will be again to them, the 10 million.
Hey, Y is paying 60 million for 50 million, is paying 60 million for 50 million.
Okay. So it will be like a loss,
Okay, it will
something
be a
like
cost to
them.
them. Okay, but for X, what will be the 10 to X?
It will be again to them.
Okay, so it means that whenever there is an acquisition, there can be a cost, but we always find a cost to the company that is acquiring, which is the predator company. How do we determine that particular cost? Okay, we look at the amount that they are paying. So the cost, we look at the amount that they are paying. Okay, the amount that they are paying. So the cash, which can be cash, or they can also give shares, or they can give cash, any of them. So you look at the amount that they are paying, you look at the present value of the value. So we look at what is the value of the company and how much they are paying. That's how we calculate the cost. That's how we calculate the
Elanos,
cost. Yes, Inia.
can you also say that it will dilute the shares of X and increase the shares of Y?
Yes, please.
Okay.
But if you are acquiring, the assumption is that you are acquiring all the shares of what? All the shares of X. So X will not be having any shares, but the shares will now be added to the shares of what? Of the Y. Okay. Okay. All right. So this is how we calculate the cost. So the cost is calculated as the cash, any amount, which is the purchase consideration. They can give them shares, or they can give them anything. So the cost will always be calculated for the company that is buying. So how much are you paying, and how much are you paying for? Which in financial reporting should have been named goodwill. Okay, should have been named goodwill. But in financial management, we don't do that goodwill stuff. Okay. Another one is that there can also be a situation where the value of, okay, let's look at this. The value of, okay, the value of X, the value of X is, the value of X is, the value of X is 50 million, and the value of Y is 60 million. If you are putting two companies together, what is going to happen? What will now be the total value of the company?
110 million.
Okay, 110 million. Okay, this 110 million They can now tell you that the new value of the company is 130 million. What is happening?
A gain of 20 million.
Okay, that's a gain of 20 million. So this can also give you a gain. This can also give you a gain, and the gain is calculated as the total value of the company or the combined company, the value of the combined company, or the new value of the combined company. Okay, let me just use the formula here. Let me just use what I have over here. Okay, so the gain will be calculated at the new value of the company minus the sum of the two companies. That is before the value before the what? The merger or the acquisition. So this is calculated as what? This is calculated as this. So the gain is calculated as the present value of the new value of the firm. So what is now the new value of the firm? That is the present value of AB. That is the new value of the company now. Plus the what? The sum of the old value. If it is 50, 60, the value should have been 110. But we are now saying that 130. So the 130 is the first one, and the summation of this one is this particular one. Okay. The cost, I've given you the cost already, which is the cash payment minus the value of the company that you are buying. There can be a gain, which we call the net present value, which is the net gain. The net gain is the gain from the merger is 20 million, or the gain from acquisition is 20 million. But you have incurred a cost of what? 10 million. If you merge or if you acquire the company, the gain is what? 20 million. But you are paying 60 million for 50 million shares. It means that you are incurring a cost of what? A cost of 10 million. So what will be the net gain? What will be the net gain from the merger? The actual gain, we are having 110 against 130. But you are paying 60 million for 50. That is a cost. And that will be a gain of 20. In actual sense, what will be the net gain from this particular merger or acquisition? Will it be the 20 or it will be a different value? Okay, that will be 10. Okay, so it means that you are having 20 as a gain, but you are paying additional 10. So the cost, you take it from this one. So that's why the net present value is just the net gain from the merger or the acquisition. So we have the gain. The gain over here is the 20 minus the cost, the additional cost that we are paying for the shares. Okay. You can also manipulate these figures. They can give you certain figures. Then you have to manipulate them. You have to manipulate them to get your what? Your values. So sometimes they can ask you for the total value of the company. So if they ask you for the total value of the company, it means that you have to manipulate this particular one over here. So if they ask you for this, it means that you add the gain plus the PV plus the PVP. That will give you the total value of the company. So sometimes they can ask you for the total value of the company, and they will be giving you the gain and the value of the two companies. So you can play with the formula to find your answer. The gain can be given to you. The gain will be given to, the gain that you'll be getting will be synergy. It will be the cost savings or the increase in the revenue. That is the gain. So if you are coming together, or if you are acquiring that particular company, or if you are merging with that particular company, what will now be the savings, the cost savings? The cost savings that you are going to be having will be the gain. So if you are merging with a company, it means that you will now be saving what? 20 cedis or 20 million as what? As a cost. And that is a gain to you. Your cost is now going to be reducing, and that is the gain. So the gains will always be given as increase in revenue or cost what? Savings. Sometimes the gain can be given to you as a cash flow, which will be into perpetuity. That means it will be forever. They can also tell you it will be for 5 years. What we do is that we find the present value of the gain, because we want to use the gain today. So what is the value of the gain? So you have to use your knowledge of what? Discounting. All right. Let's take the first question. We take another question. Then we solve the last sitting question. All right. Okay. Okay, let's move from simple to complex. Let's move on simple to complex. Okay, practice questions. A, Company A has a value of 200 million and company B has a value of 70 million. Merger between the two has just gone through and cost savings with a present value of 25 million is expected to be achieved. Company A paid a cash of 85 million for the entire paid up capital of B. What is the total value of the two firms after the merger? Calculate the cost of the merger to the shareholders of company A. What is the portion of the gain due to what? A's what? Shareholders. Okay, this is very simple. This is very simple. All right. This is a very simple question. Let me solve it using my white board. Okay. So we are using practice question 1. Okay. Let's look at the value of the two companies now. What is the value of company A? What is the value of company A? Okay. The value of company A is 200 million. Am I correct? And the value of company B, the value of company B is 70 million. Okay. There is a gain of 25 million. All right. There is a gain of 25 million. What are they asking us to calculate? They are asking us to calculate the total value of the two firms. How do we calculate the total value? We add the total value of the company now. So what do? You can see that we can use our gain formula over here to find the total value. Okay. So we know that the gain is equal to the total value of the company minus what? The value of the two companies, the summation of the two companies. So the gain over there is 25 million. So we put a 25 million here. Then we look at the total value, which we don't know. Then we now have 200 plus 70. Okay, so we have 25 is equal to the total value is minus 270. So we have 25 plus 270 minus the total value. So the total value will now be equal to 295. That is very simple. That is very simple. All right. So that is the first part. That is the A. Okay. Let's count to B. The B, what are they saying there? What are they saying for the B? The B, they are saying that calculate the cost of the merger to the shareholders of company A. The cost of the merger is just the goodwill. Okay. The value of the company that they are buying is what? What is the value of company B? What's the value of the company B? Are we here? Are we here?
Yeah, we are here.
Okay, so I want to show that you are here. What's the value of the company B?
70 million.
Okay, how much are they paying for the?
That is 70 million.
Okay, but how much are they paying?
85 million.
Okay, so we are paying 85 million for what? A company that is having.
That is 70 million, right?
Yeah, the value of the company is 70 million, but company A paid a cash of 85 million for the entire paid up capital
85.
of B. Yeah, so we are paying 85 for what? A company that is worth what? 70 million. How much are we paying in excess? How much are we paying in excess?
That's 15.
Okay, the 15 million, if you should be in financial reporting, that will be called goodwill, isn't it? All right.
Yes.
You come to financial management, it's an additional cost. So the cost in financial management to the buyer is the same as a goodwill under financial reporting. So the
15.
cost is calculated.
15 million.
Okay, the cash payment minus what? The value of the company that they are buying. Okay, that will be 85 million minus 70 million. Okay, this will be a cost. This will be a cost to the buyer, but this will be a gain to the seller. All right, let's look at the C. Let's look at the C. Okay, the C is what is the portion of the gain due to company A's what? Shareholders. So let's come to the gain here. The gain in the question is what? 25 million. Okay. But this 25 million, you can see that A is what? Spending additional 15 million to get a what? To get a 25 million. So what will be the portion of the gain that will be for the company A holders, or what is the actual gain on the merger? What is the actual gain on the merger? The total gain is 25, but before getting to the 25, they have to spend additional 15 million to get a 25. So what is the actual gain? What is the actual gain? What will be the actual gain? That will be 10, isn't it?
Yeah.
Okay. So the gain, actual gain, or the gain to the A will be 20 million, which is the same as the present value, which is the same as the present value. That will be the gain minus the cost. Okay. Also, the meaning is that the 25 of the gain, the 25 of the gain, the 25 out of the 25, 15 is for the what? For the shareholders of B. Because the shareholders of B will be getting a 15 as a gain. So 15 out of the 25 is for what? The shareholders of what? Company B. So what will be the portion for company A? And that will be the 25 minus the 15. And that will give us 10 million. Okay. Sometimes the company can ask you that what is the maximum amount that company A can pay for the what? For the shares of what? Company B. What is the maximum amount? What is the maximum amount? What is the maximum amount? And they can also ask you what is the minimum amount that they can pay? What is the minimum amount that A or B, shareholders of B, should be what? Expecting from A. Let's look at the maximum amount first. So what is the maximum amount? What is the maximum amount? Okay. All right. Let's assume that okay, you have a phone. You have a phone. That's the phone. The price of the phone is what? Is 70 million. The price of the phone is 70 million. Okay. But currently, what I'm doing is that I'm spending 20 cedis on a data daily. Okay. On a data daily. The phone that I'm using right now, I spent what? 20 cedis daily on data. Okay. I spent 20 cedis daily on data. Now you are giving a phone to me that costs what? 70 million. Okay. If I have to pay you, I have to pay you the 70 million. Am I correct? If I have to pay for a phone, I have to pay 70 million, isn't it? All right. But you are now telling me that if I should get this particular phone, I will be able to what? Save 15 cedis data every year, every day. So it means I will be spending only 5 cedi on data. But first I'm spending 20 cedis. And the phone that you are selling to me right now, you say that if I should buy the phone, I will be what? Saving what? 15 cedis on data. In actual sense, if I want to ask you for the maximum amount, or if you want to know the maximum amount that you are going to pay me, you are going to pay me the price of the phone. Okay. And you see that my phone, if you don't get a phone, you'll be spending what? 15 cedis. So you can say that the amount that you are going to pay for me, which is the maximum amount, will be the 15 million plus the what? The savings that's what I'll be getting, or the gain that I'll be getting as a result of the phone. Because if I don't buy the phone, I'll still go back and be spending what? The 20 cedi on this particular one. But if I'm buying the phone at 70 million. But this particular phone will be giving me what? A cost savings of what? 15 cedis. So the maximum amount that I can give to you will be the cost of the phone plus the savings or the benefit that the phone will be giving to me. That's the maximum amount. That's the maximum amount. Because the 17 million is for the phone itself. The 15 million is the reduction in the data that I'll be what? That I'll be incurring every day. But if I don't buy the phone will go, the 70 million will go, but I will still be consuming the data at 20 cedis. So I will still be consuming the 15 cedis. But if I buy the phone, I will not consume the 15 cedis, but I'll have the phone at the price of 70 million. So the maximum amount will be the value of the company, the value of the company that you are acquiring plus any gain. That. So in this case, the company will now be the maximum amount that they can pay for them, the maximum amount that they can pay for them will be the 70 million plus the 25. Because as the company is operating on its own, there is no cost savings. But right now that we are merging with you, there's a cost savings of 25. So the cost savings is coming as a result of the merger. So the 70 million will be for the company that we are buying, but the 25 million will be the savings that we are going to be what? We are going to be what? Enjoying. But if we don't buy you, we're not going to enjoy the what? The cost savings. So the maximum amount will be the value of the company plus any gain that will be arising from what? From the merger. But the minimum amount. So this will be the maximum amount that A can pay. But the minimum amount that A can pay is the 70 million. The minimum amount that they can pay is the 70 million. And the minimum amount is also the amount that the shareholders of B will also be expecting. They will also be expecting. So you have to look for this one. They will ask you for the minimum amount. The minimum amount is the actual value of the company. But the maximum amount that the company can pay is the what? The actual value of the company plus any gain that will be arising from what? From the merger. Let's take note of that. Let's take note of that. Very important. All right. Let's take the. So we are moving from simple to complex. Let's move on to complex at once. Okay, let me see whether. Okay. Let me move on to. Okay. Let's move on to question 2. Then we pick question 4. Then we pick question 6. All right. We still have time. Who is reading for us? Auntie Kia, can you read for us? Or you're not there? Steph, can you read for us?
Which question?
Question 2.
Yeah.
Required. What is the gain from the merger? What is the cost of the merger, assuming Robert Limited offered cash? What is the cost of the merger, assuming Robert offered stock? What is the net present value of the acquisition under the cash offer? What is the net present value of the acquisition under the stock offer? Explain why Robert Limited shareholders will insist on the stock offer instead of cash. Robert Limited is considering the acquisition of Adam Limited. Robert Limited has a value of 20,000 Ghana cedis, and Adam Limited's value is 10,000 Ghana cedis. The consultant of Robert Limited estimated that the acquisition will result in administrative cost savings of 500 cedis per annum in perpetuity. There are 2 options for settlement term. Robert Limited to pay cash of 14,000 Ghana cedis for the entire paid value of Adam Limited, or offer 50% holding in the combined firm shareholders of Adam Limited. The opportunity cost of capital applicable to Robert Limited is 10%. Required. What is the gain from the merger? The cost of the merger, assuming Robert Limited offers cash. The cost of net present value of the acquisition under the cash offer, the net present value of the acquisition under the stock offer, and explain why Robert Limited shareholders will insist
All right. Thank you.
on offer instead of cash.
Okay. Thank you. So what is the gain? Let's try it. What is the gain from the merger? What will be the gain? What will be the gain from the merger? What is the gain? If they merge, what will be the gain from the merger? In the question, what is given as the merger, as the gain? What is given as the gain? Or what item will be the gain? Let's not take the figure. What item in the question will be the gain? What item given in the question will be the gain?
Is it a 500? per annum in perpetuity.
No, let's forget about the value and identify the item that is representing the gain. Okay. Hey, my brother, that is the value between the two companies is not a gain. All right. If the merging is successful, what will happen? If the merging or if the merger or if the acquisition is successful, what will happen? Seniors, if the acquisition is successful, what are they saying that will happen?
Either there will be a cash payment or he will hold 50% shares in the business.
Okay, that is for the acquisition. But after you are acquired, what will happen? What will happen to the company? What will happen to the company's operations?
There will be a cost savings of 500 Ghana cedis per annum in perpetuity.
Okay, so if the acquisition is successful, what will happen? There will be what? Administrative cost savings. Okay, if the acquisition is not done, would there be any cost savings?
No.
Okay, so the cost savings is the benefit arising from the merger or the acquisition, isn't it?
Yes.
And that is what we call the gain. The benefit that will be coming is what we call the gain. That is the gain. That is the gain. So the gain will always be the benefit that is arising from what? The merger. It can be increase in revenue or it can be what? A reduction in cost. So if the merger or the acquisition is not successful, the cost will not reduce. So it is the merger or the acquisition that is bringing the cost reduction. And that is what we call the benefit or the gain. Okay. They are saying that the gain is what? 500 Ghana cedis per annum in perpetuity, isn't it? Okay. What we do is that we are doing everything today. So we look for the present value, the net present value. We look at the today's value of what? Of the gain. So the gain will always be given to you into perpetuity, or they can give you the present value. What you do is that you always have to what? Find the present value of the what? The gain, because we are going to use the present value to make our decision today. We are making a decision today, not in the future. So we always have to present value your what? The gain. How do we calculate the present value of a perpetuity? Under time value of money. We learned about perpetuity, and I said that it's the same as what? The cash flow over the discount factor. Am I correct? Or it is the same as 1 over R times the cash flow. Okay, so let's look at the perpetuity there. Let's look at the present value of the perpetuity. So the gain, which is the A, the gain will be equal to the present value of the perpetuity. Okay, so the gain is calculated as, okay, 1 over R. The R is always the what? The opportunity cost. They will give you the cost of capital of the company or the opportunity cost of capital of the company, or they can also give you the internal rate of return of the company, or they can also give you the return on what? Shareholders fund. We just use the cost of capital. So the cost of capital is what? 10%. That is the rate. So we have our cash flow, which will be 0.1 times what? The 500. What are we getting as the gain? Would that be 5,000?
Yes, 5,000.
Okay. So the gain is 5,000. The gain is what? 5,000. Very simple. All right. The next one is, what is the cost of the merger, assuming Roberts Limited offered cash? What are they saying? They are saying that they can settle the consideration in two ways. The first one, they can pay cash of what? 14,000. They are paying cash of 14,000 for how much? What is the value that they are paying the 14,000 for? What is the value of the net asset that they are paying the 14,000 for? What is the value? What value are they paying the 14,000 for? Ines, what value are they paying the 14,000 for?
That's the 10,000.
So what is the cost? What will be the cost of the what? The acquisition?
4,000.
That will
That's
be
the
4,000.
4,000.
Okay. So you do your this thing as the cost and the cash offer. The cost will give us the what? The cash payments minus what? The value of the visiting company. So the value of the visiting company, which is the target company. So that will give us 14,000 minus what? 10,000. And that will give us 4,000. Okay. Let's now come to the next one. Okay. They say, what is the cost of the merger, assuming Roberts Limited offered what? Stock. So if they are offering stock, what are they saying? What is the thing that they are saying about the stock? They are saying that they are going to offer 15% of the holdings in the combined what? Firm. 15% of the holdings in the combined firm. So right now, how do we find the combined value of the company? How do we find the combined value of the company? The combined value of the company is not the 20,000 plus 10,000, no. We know how to find the combined value. It is using the gain. Gain is equal to the combined value, okay, minus what? The initial value. So they are looking at the value that we have. The one that we have over here is the combined value. So this is what we are saying, the combined value. So this is the combined value of the company. This is the combined value of the company. So how do we find a combined value? We are not given. So we first have to find a combined value of the company. How do we find it? We know that the gain is calculated as the combined value of the company minus what? The present value of the company. Okay. So we know that our gain is what? 5,000, isn't it? Okay. We don't know the combined value. But we know that the value of these two companies is 20,000 plus 10,000. Okay. So we can say that we have 5,000 is equal to the combined value of the company minus the 30,000. Okay. So we are going to be having 5,000 plus 30,000 is equal to the combined value. So that will be 35,000 is equal to the combined value. Okay. So the equity option, they are saying that you are going to be offering 50% of this. So 50% of the 35,000. How much are we getting?
$17,500.
Okay. 17,500. So this is how we are going to be giving to them in terms of options. So the cost will now be the 17,500 minus the 10,000. We are paying 17,500 for this. So the cost will be 7,500. Am I correct? All right. Let's go to the let's go to the next one. They are saying that what is the net present value of the acquisition under the cash offer? What is the net present value? What is the net present value under the what? Acquisition of the acquisition under the cash offer? How do we find a net present value? The net present value is actually the net what? The net gain, which is the gain that we have gotten minus the cost. Minus the cost. That is not the value of the company. We are paying that value in cash. We are paying that value in cash. So the 14,000 is not the value of the company. The value of the company is what? Is 10,000. But we are paying 14,000 in cash. We are paying the 14,000 in cash. So the value of the company will always be the 10,000. That is the value of the company that we are buying. But the amount that we are paying is the cash consideration. So the cash consideration is not necessarily the value of the company. The value of the company is 10,000, which is the value given to us. All right. So the net present value is actually the net gain. Okay. So the gain that we have gotten from the acquisition was 5,000. Okay. Under the cash offer, we are paying additional 4,000 to get a gain. It means that the actual gain, which is the net present value, which is a gain minus the cost, will be 5,000 minus 4,000. So we are only getting a net gain of what? 1,000. That is what we call the present value. All right. If you come to the gain, the net present value under the what? The equity offer is the same as the gain minus the cost under the equity. So that will be 5,000 minus what? 7,500. We are having a loss of what? 2,500. So it means that we are having a gain, but before that gain, we are incurring a cost of 7,500. So we are what? There's a net cost of 2,500. That is what they are talking about. Let's talk about the last one. And they are saying that why should a company insist on the stock offer rather than the cash? Looking at this particular situation that we have over here, which of the options should they choose based on the computation that we have done? Which of the options should they choose? Should they buy the company by cash, or they should issue the options, the stock?
They should issue the stock.
Are you sure? If we are paying cash, how much are we paying? If you are paying cash, how much are we paying?
4,000. Oh,
If we are paying cash, how much are we paying for the company?
I don't know, we are paying 4,000.
1,000.
We are paying how much?
The cost, 14,000.
We are paying 14,000. Okay. But if we are paying by stock, how much are we paying?
17,500.
So which of them should they pay?
The
The cash,
14,000.
14,000.
Okay, they should pay cash, isn't it? But the question is now telling you that why they should issue stock rather than cash. But in actual sense, based on your computation, it should be cash, not what stock. But why do you think they will insist on the stock rather than the cash? Why do you think so?
Yeah. Because
Yeah, seniors, why do you think so? Why do you think that they should give stock rather than cash? Although the stock is more expensive than the cash. Why do we think so? Yeah.
Can I say it's because the net present value for the stock is higher than that of the cash.
No, the net present value is still a cost. We are incurring a cost of 7,500 as compared to a cost of 4,000. So the net present value is still the cost. It's still the cost. If you are issuing cash, you are going to be having a net gain of what? 1,000. But if you're issuing stock, you are going to be having a net loss of 2,500. In actual sense, it should be cash instead of stock. But they are saying that why do you think that the people, although the cash is the appropriate what option, but they will still insist on stock rather than cash? Yes, yeah.
Can I contribute? Like,
Yes, yeah.
maybe is it because stock is a capital generating resource? So rather than cash, investing in stock would increase your percentage shares in the company in terms of capital growth than cash. Is it something like that?
Okay, that is not bad. That's not bad. Yeah, I'll mention names. Okay. Okay. Hey.
Can I say because of liquidity?
Yes, the first one have to be with liquidity issues. If you are giving cash,
Yeah.
where will you get the cash to run a business? So if you are giving stock, there is no movement of what cash there. So you can now keep the cash and run the operations of the company, or to take care of what some of the operations of the company. All right. Or the company is now, if they should give cash, they are going to be in a liquidity problem. Their liabilities will fall due, but they will not have cash to pay. So because of liquidity issues, they will now insist on the stock offer rather than the cash, because they can use the cash to do other things. But the stock will not come in a form of, or if you are giving a stock, you are not giving cash. You are not giving cash. So if you give out the cash, maybe there can be a cash, the company is already in a cash problem, and there will be a pressure on the company in terms of cash. So the first reason will be the liquidity what? The liquidity issues. The liquidity issues. All right. The first one will be the liquidity issues, because the company want to reinvest the cash, or they want to use the cash for what? For the operations of the company. All right. What else do you think? All right. So the major issue is the liquidity issue. The major issue is the liquidity issue. All right. Let's look at question 4. Then we solve the last sitting question. Question 4. Question 4. Okay, someone should read the question 4 for us. Auntie Lizzie, are you there? She's gone. Network. Steph, read the question 4 for us. Stephanie. Yeah, Senior Tony, take the question 4 for us.
Question 4.
Yes.
Maku Ghana Limited is a company in Ghana operating in the manufacturing industry and currently valued at 200 million. Gini Limited is also operating in the same industry, but on a smaller scale, and is currently valued at 80 million. Due to growing challenging operating environment currently, the shareholders of both companies agreed to a 100% equity acquisition of Gini Limited by Maku Ghana Limited. A detailed research and analysis by the finance team of Maku Ghana Limited shows the following. 1. There will be incremental operation cost of 40 million per annum in perpetuity due to increased number of branches. 2. The combined company market share will improve by 50 million per annum. Based on the per annum on the average leading incremental value of 160 million per annum in perpetuity. Based on the analysis above, both parties agreed to seal the deal under the following operating terms. The payment terms, Option 1, Maku Ghana Limited to pay 170 million in cash for the 100% equity of Gini Limited. Option 2, Maku Ghana Limited to offer 25% combined company's equity to shareholders of Gini Limited as payment for the 100% equity. The cost of capital of Maku Ghana Limited is 15% per annum. Required. A. Calculate the gains from the acquisition for Maku Ghana Limited. B. Calculate the cost of acquisition to Marco if cash is paid under option 1. And C. Calculate the cost of acquisition to Marco Ghana Limited if the 25% of the combined equity is used for payment under option 2.
Okay, thank you, sir. Okay, so what is the gain here? What the gain is always the benefit. What is the benefit that the acquisition will be bringing to the company? What is the benefit? Looking at the question, what are they saying about the benefits? They say the combined company's market share will improve by 15% per annum on the average, leading to incremental revenue of what? 160. So the acquisition will now lead to what? An incremental revenue of what? 160. The incremental revenue means that the existing revenue of the company will now increase by what? 160. Why is it increasing? It's because of what? The acquisition. So the benefit that the company will be getting over here is 160 per annum in perpetuity. But the question is, are they going to incur any incremental cost before generating the revenue? Will there be any incremental cost that they are going to incur to generate the incremental revenue? Is there any incremental cost? There will be what? Incremental cost of what?
Yes.
There will be incremental cost of this. Okay. So this incremental cost is also coming as a result of what? The acquisition. So what will be the net revenue that they are going to be generating from the acquisition? What will be the net revenue? What will be the net revenue? We are having a revenue of 160, and before we can get a revenue, we are going to be incurring what? Incremental cost of 40. So what will be the net revenue?
120 million.
That's 120.
Okay. So let's come to question 4. So before you calculate the gain, you have to calculate your net revenue. So what is the net revenue or your net gain from the acquisition? You are going to be having incremental revenue. This incremental revenue is coming purposely as a result of what? The acquisition. Okay, that will be 160. And you are going to be having your incremental cost. This is incremental cost is also a cost as a result of what? The acquisition. That will be 40. So you are going to be having 120. This will now be your 120 per annum in perpetuity. So if you want to know your gain, which is the present value of the gain, will be calculated as your 120 divided by your cost of what? Capital. So that is how we find the present value of perpetuity. So that will be divided by 0.15. So 0.15. Okay. Sometimes they can say that this will grow at a rate. So if it is growing, we started a growth from this particular figure. So we started a growth from this particular figure before you go about it. But there is no growth over here. So we just leave it like that. There is no growth. All right. So what are we going to be getting? 120 divided by 1.05. What are we getting?
$800.
Okay. So our gain is what? 800 million. All right. That is the first part. Let's come to the B. Let's come to the B. Okay. The B is calculate the cost of the acquisition to Marco if cash is paid under the option A. The question is, which company are they buying? Okay, Marco is a company. Which company are they buying? They are buying the Genie. So what is the value of Genie? What is the value of Genie? What is the current value of Genie now? The current value of the Genie is what?
It's 80.
That is 80. Okay. They are buying what? They are buying what? 100%, isn't it? Okay. So they are buying 100%. Sometimes the question can say that they are buying 80%. So the cash that they will be paying for only the 80%. So what you do now is that you are going to be having, you just do like a goodwill, you're calculating goodwill. So you are going to be having 20% and non-controlling interest. So what figure you are going to use is that the figure that you're going to use will be the 80% of this. That will be used to calculate the cost. Because you are only paying for 80%. So we find 80% of this, that will be 64. So we are going to use a 64. But since we are buying the full amount, it means that we are going to be paying for the full value of the company. That is the 80. So we look at the amount that we are paying, that is the 80. So that is the value of the company rather. So we look at the value of the company and the amount that we are paying. So the B is calculated as okay. So the B, the cost is calculated as the cash payments minus the value of the company. Okay, so let's look at the value of the company. The value is 80 million. And the cash that we are paying is what? How much are they paying? How much cash are they paying?
170 million.
Okay, 170 million. Okay, the
Yes,
cash
sir.
is 170 million. So what will be the cost? It will be 170 minus 80. So you're supposed to pay 80 for 80, but you are paying 170. So what will be the cost now?
90.
That will be 90. Okay. So that is it. Let's come to the C. They are saying that you should find the cost using the equity. So the cost will give us the equity transferred, or the equity amount of the money paid minus the value of the company. So the value of the Viewteam company. We are paying for the Viewteam company. So the value of the company is 80 million. How much are we paying for it? What is the excess amount are we paying? That is the cost that we're talking about. Now, saying that in financial reporting is the goodwill. All right. So the question is, they are saying that the equity is what? The equity should be 25% of the combined what? Combined value, isn't it? All right. But the
Yeah.
question now is, how do we find the combined value? We can find the combined value by using the what? The gain formula. The gain is equal to the combined value minus the present value of the two companies. So the present value of the two companies, which can be A plus B. All right. So the gain from the question was 800. And the value of the company, we don't know the combined value. So we can put the combined value here minus the value of the two companies. That will be okay, that will be 200 plus 80. That is the present value of the two companies. So 200 plus 80. So the gain will give us 800 plus 280. That will give us a combined value. So combined value will be equal to 1080. Am I correct? Would that be 1080?
Yes, correct.
Yeah.
Yes, 1080.
Yes.
Okay. So 25% of the 1080, that will give us the equity. So our cost will now be equal to 25, or will now be equal to 0.25 times 1080 minus the value that we are paying for, which is 80. What are we having? Zero 0.25 times 1080 is what? I'm having 270.
270. Yes.
Okay, minus 80. So the cost will give us what?
190.
Okay. So it means that we are paying 190 in excess. That is all. That is all. I'm sure that is all for 20 marks or something. I don't know. Or maybe there was a theory question somewhere on it. All right. This was past question on ICA. That would be maybe, I don't know whether it is August 2022. I don't know. Okay, so that was a question that they brought on the mergers and acquisition for once. Okay. Let's take the last question, which is the last sitting question. Then we finish. We finish. All right. Okay. Yeah, Auntie Sinatoni, take the question 6 for us, which is a question on the
Lecker incorporation. Should I begin with the requirements?
okay. That one there, it depends on you. So let's start with the requirements.
Okay. Required A. Enumerate 3 advantages of expansion to acquisition over organic expansion to the owners of Lecker.
So you can this one you can answer without reading the question, because it's a theory question, isn't it?
Yes.
Okay. So what are the 3 advantages of what acquisition rather than internal expansion or internal development? What are some of the advantages?
Competitive advantage.
Okay, competitive advantage. Okay.
Synergy. Great synergy.
Okay. It also creates synergy. So creates competitive advantage. Okay, which one again? Okay, it is also easy and fast. It is easy and fast.
Then I think speed of growth.
Yeah, the speed is the easy and fast.
They can get it through acquisition.
Yeah, the speed is the fast over here. So the speed is the
Talked
fast.
about access to international markets.
Okay, you can also have access to what existing
What about
market.
speed?
Okay, the speed is the fast. Okay, so you can see the speed in the acquisition, or you can write the speed and explain. They just say you should enumerate, so you should talk about something small, at least give some small elaboration to it. That is all. So access to what? Access to existing market or additional markets or overseas market. Okay. All right. Another one is what? Access to intangibles. So the reputation and those things that the company is having, you also be having access to them. Okay. It will also give you an access to a market that what? If you want to enter it what individually, or if you want to enter it alone, you are going to find it difficult. So it will give you access to a market that you find difficult entering if you want to do it by yourself. If you want to do it by yourself. Okay, so these are some of the advantages, and that is all. So they say you enumerate, you just talk after writing it. Maybe you can just write it in a sentence form, and the explanation, everything will be there. But after writing maybe speed, then you can just explain what do you mean by the speed. You explain in 2 lines or 2. That's all. If you talk about acquisition or access to what overseas market or existing market, what do you mean? You explain in 2 lines. If you talk about acquisition to intangibles, what do you mean? You explain in 2 lines. Create synergy, what do you mean? You write 2 lines. Create competitive advantage, what do you mean? You write in 2 lines. That is all. Okay. Compute the value of Akwaaba using the dividend valuation model method and advise whether it should acquire Akwaaba at a purchase consideration of 450. This one you have to read the question before you can know whether they should do this or not. Using the price earning ratio method, estimate the expected value of Lekki subsidiary in Ghana without the acquisition. Okay, so that one is also another issue. Then state 2 reasons mergers and acquisition may fail to achieve the expected what outcomes. Expected two reasons mergers and acquisition may fail to what to achieve what the expected what outcomes. This one basically they are just talking about what the disadvantages of what of the merger and acquisition. So the first one has to do with the integration problems. The integration problems. So sometimes two businesses combining their culture, their organizational structure will be a problem. So that will be an integration problem. All right. The next one is can be the acquisition premium. You are paying more, which is the expensive part. You are paying more for this particular one. So acquisition premiums, you are paying more for this one. Or sometimes it can be maybe too much expectation. Over expectation can also be a problem. So the acquisition premium, management incompetencies. Management cannot manage the two companies as a whole. So management incompetence can also be a problem where the management of the company is managing the company like the time that they were alone, they are managing the company very well. But after the acquisition or the merger, they don't have the skills to now manage that company at that particular large skill. That can also be a problem. And also overvaluation can also be a problem. Or sometimes over expectation. You are engaging an agent, so the agent want to yob you. Because they also want to get their commission. They are going to be yobbing you so that you pay for. They will be saying things that is not right about the company because they also want you to buy the company so they can get a commission. It's just like the Ghanaian agent. They will tell you what the car or the room cannot do because they want their commission. So that particular over expectation as a result of the agents being able to deceive the people to buy can also be a factor because what they are talking about the company is not actually there. So you have paid for it and the thing is not there. So the company can crash out. All right. So let's now read the question to answer the B and then the C.
Should I read?
Yes, please. So let's read the question itself.
Question 6.
All right.
Leka Incorporation is a film company located in South Africa. The company is planning to expand into other African countries. The research department of Leka recommends Ghana as a good location for establishing a subsidiary due to its abundant talent and political stability. However, the company is unsure whether to establish a completely new subsidiary or acquire an existing film company in Ghana. You've been engaged as a consultant in taking decisions. Your preliminary assessment revealed the following. You have identified a Ghanaian filmmaker who owns a fast-growing film company called Akwaba Films. You observe that the Ghanaian filmmaker is likely to sell Akwaba if Leka could pay $450,000 as purchase consideration. Akwaba is entirely self-financed, with the owner receiving all profits as dividends. We forecast that Akwaba's profit after tax will grow at a rate of 6% per year for the first 2 years, 4% per year for the next 2 years, and thereafter grow at a constant rate of 2% per year in perpetuity. The financial information extracted from Akwaba shows the following: revenue, $250,000, and all the rest. If Leka decides to set up the subsidiary in Ghana by itself with the same 450,000 Ghana cedis purchase consideration of Akwaba, its after-tax cash flow will be as follows: year 1, 15,000, year 2, 26,000 Ghana cedis, year 3, 35,000, and year 4, 33,000. The overall price-earning ratio for the film industry in Ghana is 15 times. The average cash flow for unquoted companies in Ghana is 20%. Leka does not intend to list on Ghana Stock Exchange. Latest cost of capital is 16% required. Enumerate three advantages of expansion through acquisition over organic expansion to the owners of Leka. Compute the value of Aquaba using the dividend valuation method and advise Leka whether it should acquire Aquaba at the purchase consideration of 450,000. C. Using the PE ratio method, estimate the expected value of Leka's subsidiary in Ghana without the acquisition. And D. State two reasons mergers and acquisition may fail to achieve the expected outcomes.
Okay. All right. This one, the C should not be, I don't think should be a PE ratio. It should have been cash flow method, because they have given you a cash flow here. So it should have been a cash flow method, so that we just discount them and subtract the cost. It should have been a cash flow method. But for the price earning ratio, we use profits. So what we are going to do now is that we are going to make certain assumptions here. We are going to make certain assumptions here that the after tax cash flow is the same as cash profits. So that is the assumption that we are going to make to be able to what? To be able to do this. But the question too is that the years over here, they're supposed to give us because we have to use the current year's what? Profit or earnings to calculate the price earning ratio. But we are giving year 1, year 2, year 3. Which of the years do we know? That is the year that they are going to what? Establish this particular. If Lekki decide to set up the subsidiary in Ghana by itself with the same 450 purchase consideration, its after tax cash flows will be as follows. So maybe the year 1 now is the year that they want to what? To do this. So we are going to make certain assumptions over here and move on. But that should have been we should have calculated the value of the Lekki subsidiary using cash flow method. That should have been the best one. Okay, let's come here. We are to estimate the value. We are to estimate, or we are going to compute the value of Aquaba using the dividend valuation method and advise Lekki whether it should acquire Aquaba at the purchase consideration of this. So they're asking about dividend valuation method. Okay, the dividend valuation method, what we should do is that they're supposed to give you the cost of equity. They're supposed to give you the cost of equity for the Aquaba. They're supposed to give you a cost of equity for Aquaba so that we can use the dividend valuation model. But here is the case, we are not giving the cost of equity for Aquaba, and there is no way we can also find the cost of equity for Aquaba. There's no way we can find the cost of equity for Aquaba over here, because with the owner receiving all profit as dividends, we forecast that this profit will go and this and this. So if the owner is receiving all of this as dividends, then what will be the cost of equity for the company? We have to calculate that. They have to give us the cost of equity of the company. How do we calculate the cost of equity of the company? We have to use the dividends over the current price of the company, then we multiply. But we are not given. So what we do also is that we assume that the cost of equity of the Leka is the same as what? The Aquaba company. That is also an assumption that we are going to be making. All right. So Lekki is a firm located in South Africa company planning to expand its operations into other this one. So this question is having a lot of issues. They have to give us the cost of what? Equity for Aquaba so that we can use the dividend valuation model. But since we are not giving the cost of equity, we are going to assume that the cost of equity, the two companies are the same. Therefore, they are going to be having the same cost of what? Equity. Everything about them is going to be the same. Their financial structure will be the same. Their operating risks will also be the same. So therefore, since they are all film making companies, then it means that they are all going to be having the same what? Cost of what? Capital. They're also going to be having the same cost of what? Capital. They're also going to have the same cost of capital. So the cost of capital will be 16 what? Percent. Will be 16% as for the liquor. They have to give you the cost of capital for the Aquaba company. But since we are not giving the cost of capital and we don't have any information to find the cost of capital, we don't have any information. They should have given us maybe at least capital asset pricing model, or they should have given us the cost of capital straightforward. But since we are not giving the value of the cost of capital, then it means that we have to use the Lekki's cost of capital as the cost of capital for Aquaba, because they are company of the same nature and they are operating the same what industry. The cost of equity for Aquaba will be assumed to be what? 16%. Let's now look at the top. Let's now look at the top. Let's now look at the top and see what they are talking about there. Okay. They are saying that Aquaba is entirely self-financed, with the owner receiving all profits as dividends. With the owner receiving all profits as what? As dividends. With the owner receiving all profits as what? As dividends. Okay. With the owner receiving all profits as dividends. You forecast that Aquaba profit after tax will grow at a rate of 6% per year for the first 2 years, 4% per year for the next 2 years, and thereafter grow at a constant rate of what? 2% per year in perpetuity. All right. What's the current dividend of the company?
Like 60,000. That's the profit after tax.
Okay. So the current, because they are receiving all dividends as what? As profits. They are receiving all profits as dividends. So the profit after tax will be their dividends. The profit after tax will be their dividend. That will be 60,000. Okay. That is the current year what? Dividends. That is the current dividend, or that is the today's dividends. That is the today's dividends. Okay. What are they saying? For the first 2 years, what will happen to the dividends?
To grow by 6%.
Okay, so let's find the dividends. So let me put question 6 here. So the current dividends, which is the current earnings, the current dividends, which is current earnings, is 60,000. Okay. So for year one, what will be the dividends? So let me put the dividends here. Okay. Year one will grow by what? 6%. So year one will be what? 1.06 times 60,000. Is that not year one? The dividend for year one will grow at 6%. So that will be 1.06 times what? 60,000. I'm having 63,600.
Yeah.
Okay. That will be at the end of year one. Year two will also be 1.06 times what? The current dividend for year one. Am I correct with that? Okay. I'm having 67416. Is that correct?
Yeah, yes, sir. 6741.
Okay. Okay. Then 4% for the next 2 years, isn't it?
Yes.
So the 4% for the next 2 years will be year three. Year three. So year three, the dividends will be what? It will be okay. So let me add the growth here so that it will not confuse us. So let me add growth here so that we know how we are calculating the growth. Okay. So this will be 1.06 times 60,000, which is the current dividends. This will be 1.06 times 63,600. Okay, so this will be 1.04 times 67416. Am I correct?
Yes, sir.
Okay, that will give us how much?
112.64.
Okay, 7112.64. Okay, year 4 will be give us 1.04 times 70112.64.
729 17.15.
Okay, 729.197.
7.15.
Okay, 917.
97. Yeah.
Okay, 0.15. Okay, year 5. From year 5, it will be how much?
2% still.
Okay, it will be 2% up to what? Perpetuity, isn't it?
Yeah.
Okay, so let's look at year 5. 72917.15. What are we getting?
74,375.49.
So 73.
74.
Okay, 74.
74,
Okay,
375.49.
so 74, 74, 3.
75.49.
Okay, 375. Okay, 375.49. Okay. All right. So this will be up to perpetuity, isn't it? All right.
Yeah.
This will be up to perpetuity. But what do we do? You see, last time we learned that the market value of a share is the same as the present value of all the dividend payments. Okay. Under the dividend valuation and cost of capital, we learned that, okay, if you want to find the market value of the company, okay, I've given you a certain amount of money now. It is that particular amount that you are paying me a return, which is a dividends every year. So the return that you are going to pay to me, you are paying it as a result of time value of money. You should have given me the return of 100,000 today because I've given you 100,000. But since you're not going to give me all the 100,000 today, you want to spread it over a certain number of years. So I'm going to consider time value of money to it. So it means that if I should present value all the money that you are giving to me on the money I've given to you, it should be the same as what? The money that I've given to you today. So the market value will be the same as the present value of all the what? All the dividend what? Payments. So what we do is that we find the cash flows using the dividends. So we have the years, we have the cash flow, we have the discount factor, then we have the present value. So the discount factor over here will be the 16%. They have to give us the they have to give us okay, so okay, so they have to give us the cost of equity before, but they haven't given us the cost of equity. But let's count to this. Let's come to this. So they are saying the company is self-financed, isn't it? You observe that the Ghana filmmaker is likely to sell Aquaba if Leke could pay this and this. Okay. Aquaba is entirely self-financed, with the owner receiving all profit as dividends. What can you make out of that? The owner receiving all profit as what? As dividends. The owner receiving all profit as dividends. The owner receiving all profit as dividends. What can we make out of that? Can we say that the cost of equity is 100%? Can we say that the cost of equity is 100%?
Uh,
Are you sure? Are you sure? Are you sure it will be 100%? 100% of what? $100% of what, Philip? $100% of what? How do we calculate cost of equity? It is a dividend over the market value. Okay. It is a dividend over the what? Over the market value. Okay. Okay. It is a dividend over the market value. Okay. But the question is the DO over PO. Okay. The company is what? Is self-financed. And what will be the equity? It will still be at the equity that they have put there. Okay. So the question now is, if the company is self-financed with the owner receiving all profits as dividends. So anytime that you make profits, you take 100% of what? Of the profits. So it means that any profit that you are going to receive, you are going to be taking 100%. That means that the cost of equity is the same as what? The 100%. Okay, that is the assumption that you are making. That is the assumption that you are making. Okay, that is not bad. That is not bad. The owner taking all the 100%. 100%. It cannot be 100%. It cannot be 100%. Okay. Cost of capital is not calculated on profits. Okay, it's not calculated on profit. It's calculated on market value. But the question should have given you the cost of capital. But since there's no cost of capital, you just use the cost of capital of the other company, which is a 16%. All right. All right. Okay. So let's look at year one. Okay. At the end of year one, what will be the dividend? What will be the dividend? That will be 63,600. Okay. Year two will be 67,416. Okay. Year three will be 70,112.64. Year four will be 72,915.15. Okay. From year five, this will now be constant throughout. So what we are going to do is that we are going to find the annuity value of this. We are going to find the annuity value of this because the growth is going to be 2% up to perpetuity. Let's calculate the discount factor for this one by one. We're having 1 divided by 1.16. I'm having 0.862 for the first one. 1 over 1 plus r exponent n. That is what we are going to be using. Okay. So 16, what are we having? I'm having 0.862. Someone should confirm that. Please, can we confirm that?
That's correct.
Okay, the second year will be what?
$0.743.
0.743. 743.
Yeah.
Okay. Yeah, 3 is what?
Uh, 0.641.
0.641. Okay.
Then year 4 is 0.552.
Okay. 0.552. Zero point five five two. 0.552. Okay. All right. Let's find the present value. What will be the present value for the first year?
The first year is 5482.32.
5482.32.
32.
5482.
0.32.
Okay. 54.
82.
Mhm.
5482.32.
Hey, are you talking about 5,000 or 50 something thousand? 0.862 times
Sorry.
63,600. Okay. So it will be 3.2.
Yeah.
Okay.
Yes.
Okay. Let's count to the second one. The second one is 50.
50090.8.09.
Okay, 0.09. Okay, the third year is what?
$44,000. 44,942.20. 44,942.20.
Yeah, it's what?
44
44.
942.20.
Okay, 44942. Okay, so 44. 44942.
Yeah.
20.
0.20. Okay. The fourth one is what?
That's 40,271.49.
Okay, 40,271.
1.49.
Okay, 0.49. Okay.
Is it?
Someone should confirm 40.
Is it 4250? Is it 0.552, right?
Yeah, 0.552. Yeah.
The present value. This yeah. That so it will be 40,250.27.
Okay, 250.27.
I'm thinking approximation.
Okay, 0.27. Okay. Okay, so that is what will be the total?
One 105.76.
Okay, 190.
Yeah, 105.76.
105.76. Okay, that is on the dividend that we are going to do, but this is based on the normal growth. But what about the perpetuity? So the value that we are having, this value is for the first 4 years. That is the present value for the first 4 years. Okay, that is the present value for the first 4 years. But let's count to how do we calculate the perpetuity? How do we calculate the present value of perpetuity? Okay, you can see that the present value of perpetuity, the figure that will be growing up to perpetuity is the 721715. It is this figure that will be growing now from the next year up to perpetuity. It is 72917.15. That will be the figure that will be going up to perpetuity. So if you want to calculate your present value now, this will now be the dividend at the end of year 4, because the dividend is growing at a constant rate. So we use the D4. That is the dividend that will grow at a constant rate. Into bracket 1 plus the G, which is the growth, over your cost of equity minus the growth. It's just like the value of the shares, how we find the value of the shares. So we have the market value here, which will be the dividend that is going. It will be a 721, or you can use this one. You can use this, but this will be the dividend that you are going to be using. So you are calculating the market value at the end of year 4. So you can put this one there and grow it, or you can just put this one here, which is the dividend for the next year, and use it to estimate it in year 4. So we can use this now, the 74. So 743, or let's just use the third year so that we can just do the growth in the bracket there. That will be 72917, 72917.15 into bracket 1 plus 0.02, all divided by 0.16 minus 0.12. Okay. 0.02 rather, which is a growth. Okay. So our market value will now be equal to, okay, so if you grow it, it will give you the 743.75.49 divided by 0.14. What are we getting?
Is the growth 20% or 2%?
That is 2%, so it's supposed to be 0.02. The perpetuity is 2%, not 20%. What are we having?
as 531253.52.
0.5.
Okay. 53
Mhm.
1253.
1253.5,
125.5.
isn't it? Okay. When are
Yeah.
we estimating this particular value? Is it at the beginning of the year? Is it today that we are estimating it? If it is today, it means that we have to use the today's dividends. And the dividend that we are using over here is the 4th year dividends. It means that we are estimating this at the end of the 4th year. So if we are estimating this at the end of the 4th year, then it means that we have to find the present value of this particular figure to today's term. So 531253.5 multiplied by the discount factor at the end of the year 4. That will be 0.552. So we estimated the value at the end of year 4. If you are doing it today, then you have to use the current dividend before you increase it by the growth. But we are using the dividends at the end of the 4th year. So it means that we are estimating this at the end of the 4th year. So if we are estimating this at the end of the 4th year, this is the value at the end of the 4th year. So what will be the today's value? We present value it using the discount factor for the 4 year. What are we having? Times 0.552. I'm having 293, 25, 251, 251.93. So your total market value will be equal to the figure that we have gotten over here, which is the one based on this particular dividend, which is 105.76 plus 293,251.93. What are we having? So it will be the normal present value plus the perpetuity, the present value for the perpetuity. So these ones plus the perpetuity. What are we having? 190,105.76. We're having 483, 357.69. Are you having the same thing? The total market value. All right. How much are they paying? How much are they saying that they are going to be paying? How much are they asking them to pay? They're asking them to pay what? 450, isn't it?
Yeah.
Okay. If they are asking them to pay 450, what should have been the actual value of the company? They're supposed to pay 483,000 something. So it means that it is worth paying what? The 450 for. Because the actual value is more than the 450. But since they are asking them to pay 450, it means that the current market value of the company is 483 this and this, and they're asking you to pay the 450. So you are paying lesser than you should. So they should go ahead to pay the 450 because the value of the company is 483,357.69. But a situation where the value of the company is like 400,000, okay, it means that they can't pay the 450 because they are paying higher than what they should pay for. But if they are paying lower than what they should pay for, then they should go ahead to pay. So they should pay the 450 for the company because the market value of the company is 483,357.69, which is higher than the amount that they are paying for, or which is higher than the amount that they are paying. So they should go ahead to pay the 450. So you advise them based on the market value that you have gotten. They might be paying more than, or they might be paying lower. So you advise them based on the what? On the market value that you have gotten under the dividends valuation model. Okay, let's look at the price earning ratio. The price earning ratio. The price earning ratio, we know that it is the profit after tax multiplied by the price earning ratio, or it is the earnings per share multiplied by what? The price earning ratio. All right. They are saying that if Lekki If Leka decides to set up the subsidiary in Ghana by itself with the same 450,000 purchase consideration of Aquaba, its after-tax cash flow will be as follows. So the overall price earning ratio for the film industry in Ghana is 15 times. The average cash flow for unquoted companies in Ghana is 20%. So the average cash flow for unquoted companies in Ghana is 20%. Lekki does not intend to list on the stock exchange market, on the Ghana Stock Exchange. So what they are trying to say is that this particular figure over here is representing 20% of the entire cash flow in the industry. So because they are not expecting to list the company, this is the cash flow for the company, which is at 20%. So the cash flow for unquoted companies in Ghana is 20%. What for the company that is listed, that will be 80%. So the cash flow given to you over here is just a 20% of the of the cash flows in the in the Ghana Stock Exchange market, or in the market in Ghana. Companies that are operating in the unquoted in the industry, the cash flow, 100% of the cash flow, 80% is for the company that are listed, 20% is for the company that are not listed. So these cash flows given to us over here is the 20% of the entire cash flows in the industry. And since the company does not intend to list on the stock exchange market, it means that these are the cash flows that they can use. All right. But the question is, the price earning ratio is 15. We normally use profit. Price earning ratio. If you want to use a price earning ratio, the value of a company, we use the value of a company is the price earning ratio multiplied by the earnings per share, or the price earning ratio multiplied by the profit after tax. But here is the question: we are not giving profit after tax, and we are not even giving the years. We are not even giving the years. So what do we do? What do we do? We are not giving years. What do we do? We don't know which year that we are going to be using to calculate the value of the company. But we can make an assumption that the after-tax cash flow is the same as the after-tax profits. So the first year, the profit for the company for the first year is is 15,000. This is 26,000. This is 35,000, and this is 33,000. Okay, so what value are we going to be using now? The best way to go about this is that we should just find the average of the profit. So let's find the average profit and use. Let's find the average profit and use for our computation. Let's find the average profits, because we don't know which year that we are going to use for as a calculation, because they are giving you year one. This is at the end of year one. These are the end of year one. And this is at the end of year two. So the question should have been, find the expected value using cash flow method, so that you can just discount these values, you discount them and subtract your 450 from it. That is it. That is it. But since they are saying that use price earning ratio, you have to assume that all the after-tax cash flow over here are the same as after-tax profits. After-tax profits. And what is going to happen is that you can't discount the profit. We only discount for cash flow. So you add the profits, and find average profits. So your value will be equal to the price earning ratio multiplied by the average profits. Let's find the average profits. Let's find the average profits. So using the C, our price earning ratio, we have the value of the company. The value is equal to the price earning ratio multiplied by the average cash flow, or average profits. Okay, so how do we find the average profit? Let's put the profit together one by one. Okay, we have 15,000. We have 15,000 plus what? plus 26,000
26,000 plus 35,000 plus 33,000.
plus 35,000 plus 33,000. Okay, all divided by 4. Are you correct?
Yeah,
Okay, what will be the average profit?
that's 27,250.
27,700.
250.
250. Okay. 250. Okay, so our value of a company, the value will now be the 15 times 22, 250. Okay, so what are we going to be having? I'm having 3333750. Is that correct? Is it 333750?
Lost it.
Okay, this is a company that is not listed, so we adjust this by 80%. So this is a company that is not listed, 33557. So we now have times 15 times 0.8. So I'm having 267,000 as the value of the company. As the value. All right, that is all. Any concern? Friday, we look at working capital management. I'm already tired, and I know you are also tired. So, seniors, I'll see you on Friday.
Linus,
Yes, please.
the this thing is rather you 27,250, but I did it 22. Oh, I'm not seeing it.
It's supposed to be 27.
Yeah, 27,
Okay.
250. Yeah.
So 27, 250. 27. So if you multiply, what are we getting?
You get that's 408,750.
Okay. If you multiply by 80%, what are we getting?
That's 327,000.
Okay. All right. So seniors, I'll see you on Friday. And we are starting working capital management. And by 10 February, we should be finishing. But by the end of this month, we are going to be doing a pre-mock. So the pre-mock will be based on the questions or the topics that we have done so far. So we are hoping that before the month ends, we will be finishing the working capital management. So there will be a question on the working capital management. There will be a question on the working capital management. But I'm not sure that there will be a question on investment appraisal and financial risk management. But since you're a student, you have to learn everything. So I can still decide to surprise you or to shock you by bringing question on financial risk management. Or I can just set a question based on what the examination structure. So you have to take note of that. All the assignments, I can pick the question from the assignment or I can pick the question from anywhere. So let's try and see. I will come. It will be like normal class like this. Okay, your videos will be on and I'll be here. I'll on the Zoom. You also be on the Zoom. Your videos will be on. Your calculator will be there. And you'll be solving the question for 3 hours. After the 3 hours, then we just finish. Then you send a solution to me. That's all. It's a very simple one. All right. So seniors, any question? If there are no questions, then I would like to take my leave.
Okay, thank you very much.
Okay, thank you, sir. You're welcome.